So a couple weeks back, we talked about one way to analyze the potential impact of a single stock on a broader index. So if a stock is expected to move 5% and it makes up like some, it's one of the components of the index, how much can we expect the index to move? There's a way to calculate that. So today I did my very, very best to backtest this. And it's very hard to do for reasons that I will get into. But I really wanted to look at some significant moves in some major names over the last year approximately and understand how the realized moves in the S&P kind of compared to that, to those expected estimates. Make sense?
Yeah.
Okay, let's try to get through this quickly. This is a recap. I'm probably not going to spend a lot of time on this. If you want to go check out that segment, it was from 2 weeks ago. But basically, the expected move of a stock, the expected impact on a stock can be estimated if you have an expected return for one stock and the correlation between the two of them. So for example, like let's say that two stocks A and B are correlated with a correlation of 0.8 and expected A is, stock A is expected to move 5% around earnings. So the expected impact, I guess, on stock B is just the correlation between them times that expected move. So 4%. Make sense?
Okay, yep.
Okay, next slide. Okay, so that previous case is if we assume the volatilities are similar. We can also sort of like beta weight this a little bit by taking the volatility of, the standard deviation of returns of stock, whatever you're interested in, dividing it by the expected, the standard deviation of returns of whatever you have the expected move for. Make sense?
We've been doing this for years, beta weighted notional IV.
Very similar, very similar. Okay. But this is for expected move. If you want to consider the expected impact
I
of one
understand.
stock on another stock, right?
Yeah,
Okay.
I understand.
Okay, let's go to the next slide. So if you wanted to extend this logic to an index, right? You take that formula,
Yeah.
multiply it by the weight of that holding in the index, and then you just sum all them up.
Okay.
Like, right, you're just taking a weighted sum of all those expected moves, basically. Make sense? So like if I wanted to calculate, like Apple is, going to move 5%. We're expecting it to move 5% when it reports earnings. What is the expected move in the index, right? I can take all the holdings of the index. I can take the correlation between all those, holdings and Apple. And I can use this formula to calculate how much should the S&P move from that move expected. Make sense?
Yes.
Easy peasy. Okay, let's go to the next slide then. So what I wanted to do was actually try to look at some data to see how well this holds up. It's very difficult to do this type of backtest for like two reasons. Number one, there's not a lot of very big moves that you can really look at over, some time frame. Here I wanted to look at the top holdings of the S&P. So that's Apple, Microsoft, NVIDIA, Amazon, Meta, or Google. They all kind of move around in the top like 6 spots basically over the last couple of years. And so I wanted to say, okay, on the days when these, assets had moves that were larger than 5%, either to the upside or to the downside, what was the expected, index impact? There's not a lot of moves like that happen in this period of time. And then in addition to that, you also need the historical weights of the S&P over your backtest period. And those aren't really easy to get. So not a lot of data here, but I wanted to see if there was maybe something interesting that could come about. And so here we looked at from 2024 to 2025. We want to see like Apple, Microsoft, NVIDIA, Amazon, Meta, and Google, like when they have a move greater than 5% or less than 5%, how did the S&P, what was the expected move in the S&P, and then how did it actually move? What were those results? Make sense? Using that formula that I showed on the previous slide.
Sure.
Okay, let's go to the next slide. So, unsurprisingly, when a major holding in the S&P has a large move to the upside or to the downside, the index is unsurprisingly expected to follow suit. In fact, for moves that are this large, remember we're looking at plus minus 5%, the index in this very limited data set was expected to have the same sign of daily return, so move to the upside or to the downside at the same time, 100% of the time, right? So like if any of those holdings move like 5% to the upside, we would expect that the S&P should be positive that day based on this expected return that we looked at in the previous slide. Does that kind of make sense?
Yeah, totally.
Which totally makes sense, as you would expect, right, Tony?
Yeah, sure. Makes sense. I'll give you a sound off answer.
Yeah, it makes sense. We're looking at very large moves. So like here we're looking at like Meta was up 20%. We would expect the S&P to move up some percentage. And generally we'd expect that to be positive if Meta is moving to the upside 20%. That's effectively what we're saying here in this backtest. When we looked at the expected moves for these very large moves in the holdings of the S&P, we would expect that the S&P would have at the very least the same sign as this company that was moving very much to the upside or to the downside in this backtest. Does that kind of make sense?
Yeah, totally.
Let's go to the next slide. So when we looked at the actual moves, we did see that like the direction kind of aligned with the expected move, but the actual numerical values differed by quite a bit. So here we have all of those, those, I think it was like 36 data points, all of those big moves in those 6 holdings over the last year. And that kind of hatched bar shows the expected move, and then the kind of solid bar shows the realized move, and then it's green for positive and it's red for negative. What we can see is that when we expect a positive move in the S&P is usually positive. And when we expect a negative move in the S&P is usually negative. But the actual size of that move can vary from its expected value quite a bit. And that's usually because there are a ton of other factors that are actually moving the markets. We're looking at very extreme moves. So these are kind of edge cases.
Oh, what are you trying to prove?
I'm trying to prove anything. But I did notice something a little bit weird that inspired this backtest that I'll talk about in a second. And I kind of wanted to talk about it. That make sense?
Okay. I'm just trying to figure out what you're trying to, what you're going for here.
Let's go to the next slide. So I wanted to look at a couple interesting examples, maybe, and I don't know if we're going to have time to do it. But so in February 2nd, Meta jumped over 20% after earnings. And the expected move in the S&P was about 3%, but it only moved 1%. Okay, let's go to the next slide. So on August 5th, NVIDIA dropped over 6%, and the expected move in the S&P was 0.75%. However, the S&P dropped almost 3% because that was also coupled with concerns around the Nikkei crashing, right, over 12%.
Okay.
So we can see there's a lot of instances when these kind of like external factors sort of like move the markets in ways that sort of deviate from these expected moves. But what we do actually see, if we go to the next slide, is that 89% of the time, the signs of the expected moves and the realized moves were the same. Right. So even though NVIDIA dipped, or I'm trying to think how to describe this. So even though Facebook's earnings or Meta's earnings might have caused this very large move, the actual move in the S&P might not line up with that expected value, but the signs usually do. That happened about 89% of the time. So we found that it was actually pretty weird, generally speaking, for the move in the index not to match the sign of one of these major holdings, sort of when they have a big move. Does that make sense?
Yeah. So the expected moves and the realized moves were this. Yeah, sure.
That kind of makes sense, right?
Yeah.
But interestingly, and that's kind of what inspired this a little bit. If we go to the next slide, we had 2 deviations from that, like recently, actually. 2 pretty significant deviations. And we'll talk about that more in the next slide. There we go. So on January 30th, Microsoft dropped 6% after earnings. And there were other concerns that kind of were also bubbling up around that time as well. On February 5th, Google dropped over 7%, also around earnings, and the expected drop in the index was 1.7%. So in both of those cases, we expected some pretty big drops in the S&P, but they actually turned out green. Do you remember those days? It happened pretty recently.
Yeah. Yeah. I mean, I don't remember, there's a lot of days when Google or Microsoft or NVIDIA have had big, even mostly Apple, have had huge moves. And the index has done not what we expected, but I think I remember both those days.
That's weird. That doesn't happen a lot. When we're talking about moves that are greater than 5%, it's actually weird for one of the top holdings in the S&P. That does not happen very much. That happens in this data set.
It's happened recently more so, I feel like, because just in Apple alone.
Yeah.
And then Tesla had dropped 30% as the market was going higher for the last 2 weeks. So it's kind of weird. There have been a few weird moves like that.
It's weird, and it's been kind of recent. And 2 data points is not enough to indicate a trend. And there's been other data points as well. We were just looking at 6 companies basically. But I kind of wanted to look at this because I think it's worth watching over the next couple of months because it has felt weird. And I wanted to see if any data kind of supported that. And it turns out 2 very big moves, 2 very big drops in Microsoft and Google, we would have 100% expected the market to end red those days, and it turned out green.
Yeah.
And I'm wondering if that kind of might indicate that there's some shift in market dynamics right now, or some maybe shift away from tech, or some shift away from AI, or something that could be resulting in maybe more optimism that was kind of reflected in the index after these 2 very big drops happened. Those were weird. And I kind of wanted to try to do a study that showed a little bit of context to show exactly why. Because it's not out of the realm of possibility for Apple to drop 3%, or for Tesla to drop 4% and the index to wind up green. But when Microsoft drops 6% and Google drops 7%, and we're expecting the S&P to drop almost 2% in both of those cases, and then it turns out green, that's weird. It's not weird, but it deviates from sort of the expected behavior that we can measure, at least looking at the last year's worth of data. That's what I was kind of trying to look at.
I get it.
I mean, it just means it's broad based.
Yeah,
the
Yeah.
market is kind of.
I'm not sure that I can draw any takeaways from this that I can actually use.
Yeah. That's why I wanted to try the back test, and the back test was difficult for the reasons that I described. But it was really those 2 data points that I found really interesting. And that's why I found it was interesting. It's like I've been feeling this in my portfolio personally, where we'll have these really big moves, but then the indexes won't move very much. And it felt like that's been happening more recently, but it was really hard to actually measure that. And this was kind of my attempt at
That's
of
fair.
doing that.
I mean, there have definitely been some individual stock moves. You know, today's another example, but I don't know if some of it has to do around earnings time or not, but yeah, I understand where you're coming from. I just don't know how to take something away from this that I could actually use.
Yeah, it's difficult to say because, again, it's not a lot of data that we're working with. Like, if the indexes are maybe more resilient now than they have been to some of these moves, or a little bit more insulated from some of these moves, you can't really claim that from a couple of data points. But it's a trend that I want to keep watching as we sort of continue to have like more, volatility in 2025. So it's that was the point.
Beautiful, lovely,
sick. Let's go to the takeaway slide. We'll finish up. So the potential impact of a single stock on an index can be estimated using historical price data and a detailed list of index components and component weights. And based on this very limited backtest, the data roughly supports that when major holding is expected to undergo a large move, we can expect the direction of the index move to match. And large moves resulting from earnings might move the index less than expected compared to, moves resulting from market or sector-wide events, but we kind of need to do more research to be able to validate that. And as well, if there is a trend, it's not really measurable yet because there hasn't been enough data. But I think it's worth watching going into 2025 because it's felt a bit weird trading, and it was kind of hard to actually put numbers behind that before this kind of test sort of came out.
I don't know if there's a trend, and I don't know if it's a bad thing either.
I don't know either.
Yeah.